Q&A time from the last market outlook. I have not had a single chance to look at any of these questions, so I will be seeing them with you at the same time. If this is your career, are going to be, then having the applied series is a must. Oh, okay, well that's good. The amount he is charging is nothing compared to the value you're getting. So that's consistent with the way I've always done things, even with CFA. I have a belief of cost plus pricing, which is what does it cost me to get done? And then of course I got to make something on it, because I could always just go back to the university, right? And that is the price that you pay. Other places have value pricing. In other words, they determine what value you would derive from it, and that is the price that you would pay. I sort of think that if you're deriving value out of it, aren't you doing the work to get that? How can I possibly charge you for what you're bringing to it? I don't like that idea, so it's always cost plus. And I do believe in the concept of deliver overwhelming value. You can buy a lot of forgiveness when you deliver overwhelming value. So if you're a week late getting something up, people forgive you because it's like, oh well, considering the price I paid, it's not a bad deal. So thank you for the compliment. This is something I've always wanted from every class I've ever taken. Mark just drops it on YouTube. Oh, another compliment. I usually don't read those. It seems self-serving, but again, it's the first time I'm seeing these. Okay, there's another one. We'll skip that. The idea of publishing new positions on Fridays rather than Sundays would be very helpful. I think so. And it from now on, in case those listening are not aware, the new positions is going to be far more detailed because it's going to be in the applied level. So I'll go into detail on each position in terms of what my whole trade strategy is. So I may say I'm going to look at ABC, and here is how I'm going to get it over the following months. Whether it's going to be an allocation, whether it's going to be income based. Sometimes it's both allocation and income, so I hope to build an allocation and generate income with the options on these. What the fundamental reason for it is, and sometimes a fundamental reason is nothing more than it has a great dividend and really nice options that I can manufacture a beautiful income stream off of here. So sometimes just generating cash flow is important enough. I don't necessarily need the capital gain. So I'll be going into a lot more detail. I think putting it out Friday makes a lot of sense, because then you have the weekend to think about it for yourself and how you would approach it. So yeah, this will be put in the applied level in the portfolio construction module. And that starts on Sunday. The first one starts this Sunday, and I do have a lot of positions, new positions that I've been looking at in the Canadian market because we are going into a, I think, significant rate cutting cycle. So there are some interesting plays there for stocks that tend to do well in rate cutting cycles. Love your content. CFA level 2 candidate before quitting. Well, why'd you quit, dude? I learned so much more from you than I had from the CFA curriculum. What I do is very applied. If you have the CFA knowledge behind you, and the CFA is really, when you're undertaking CFA, you are studying finance. With the applied level, you're practicing finance. Bring the two together. And when you bring the two together, that means in time, I as a teacher achieve the greatest outcome, which is you don't need me. Once you determine that you do not need me, there is success. That's the goal of everything. So I don't know that I would just focus on one. Make sure you have the other one down at the same time. Do them both together. This will give you the firm foundation you need to understand what I'm saying over here, and it also allows you to take what I'm saying and go even further than what I'm doing. And when you determine after a while that, you know what, I don't need this guy anymore, there is success. Okay, another compliment. Sorry about this. I normally don't read the compliments because it seems self-serving, but maybe I should just look through these first before I do this cold. Since you mentioned TLT options here, I almost was about going long January 26 calls this coming Monday, but then realized three additive issues regarding the breaking even of this trade. Minimum break even, required declining interest rate is the dividend distribution. Yeah. Equivalent rate cuts, roughly 16%, 100 basis points. Bid-ask spread round trip cost, 7%. Ooh, if sold before, roughly 7% for the at the money. Well, if the bid-ask spread is 7%, you think the bid-ask spread is 7% on the January? That doesn't seem right. January 26 calls, because TLT's around 99 bucks, so you'd have to have about a $7 spread on the January calls. Bear with me here. I'm going to hop over to the options chain for TLT. Let's just have a look at that, because I think you might be looking at the wrong thing. There's January 26 here, and if we look at the money, TLT's now 98. Go to the, you're looking at the money. Yeah, at the money, 98. 760 to 785. The bid-ask spread is not that big. I think you're calculating the 7% as the cost of the option, the premium on the option, which is around 7%. So I think you're wrong on this one. Option premium recovery, maybe like 10%. I don't know what that means by premium recovery. What you're doing is you're buying the 98. Looks like you can get it for call it 770. That means 105.70. You got to get above 105.70 by that time. You are right on the dividend. You got 6 quarters of dividend, so roughly 6% that you would lose. However, that 6% is in the price of the call. It is lower by that amount. This is what is called negative carry. You have negative carry here. You have to find a way to get positive carry. Which would mean selling something somewhere else that has positive carry. In total, all these hurdles just to break even makes the 1.5-year trade betting on dropping 10 to 20 yields unattractive. Well, if you get a 200 basis point move, if we believe the pricing in Fed funds futures, and we get a 200 basis point move to the downside with a mod duration of about 16.5, that implies a 33% move on TLT to the upside at 98. 33%, call it $33 or roughly, or $32 brings you to 130. If your break even is 105.50, it's still not bad. So if you still think you're going to get that move, also keep in mind that the dividend that you receive on TLT on an after-tax basis is not as efficient as a capital gain. So there is some value in doing this. This is you're bringing leverage to the trade, right? So if you had the cash, let's say you did one call, if you had the cash, if you had $9,800 that you could simply just buy TLT, and you bought a T-bill maturing in, well, T-bill wouldn't mature in January, but let's say you rolled them over in 3-month T-bills. The gain on your T-bill in terms of the money market rate you would earn offsets the negative carry you have in the option. So the option becomes free in that sense, and your money is sitting in TLT. Your money is sitting in a T-bill that is earning the cost of carry. So as your option premium decays with theta, you earn it back on the T-bill. That's if you wanted to use the cash to get that done. So rather than buying the stock, you bought the call and used cash to offset the carry. You basically would end up with the same situation as if you had bought the stock, right? If you think about put call parity, the only thing that's missing is the put, because that would have the present value of all the dividends in it. Now you have a synthetic long position. But there's still, if you think about 200 basis points and the duration with a target price by January of 26, if you think 200 basis points by January 26, target price of 130, break even of 105.5, what is that, a $25 gain roughly for an investment of $7 and what did we say, 80 cents? $7.80, you get a $25 gain. What is that, over 300% return? No, I still think there's value in doing it. The premiums are coming down, by the way. The premiums are coming down because by January 26th, this is being priced out on the forward curve, along with the forward curve of money market rates, which are lower. So as interest rates start dropping, when I say interest rates, as the Fed funds rate starts dropping, call premiums will start dropping as well, because the interest rate that it's priced on will be dropping. Anyways, I spent a long time on that question, but no, your break even based on what you're forecasting is still fairly good. In fact, I may even do that one myself. It looks pretty good. OAS data. I understand how to calculate OAS for a single callable or puttable bond, but what about bonds where the OAS numbers you're showing? But for what bonds are the OAS number? This is for a group. So what we're doing is, or at least what the data is doing, is it's saying IG, an index of investment grade bonds for the index. You'd have to look at, well, how is that index constructed? But the OAS on this index has 51 basis points, or I think, what was it, 90 some basis points on the OAS. That is a portfolio of investment grade bonds. Every rating has that. A AAA, AA, A, triple B, double B, B. Every rating has an OAS. The OAS of 121 for triple B on average OAS, overall puttable, callable, triple B rated corporate bonds. Yeah, whatever the portfolio construction is that makes up the index of triple B, that is the OAS on a broad, call it a broad portfolio of triple B bonds. Why are you more interested in OAS than G-spread? Well, G-spread is not a tradable spread, and the G-spread is, you could have a differing G-spread without the credit risk of a company changing. So let's take a yield curve that looks like this right now. There is the 1 year, there's the 2 year, the 10 year, and let's say you have a corporate bond sitting here, and then you get a curve steepener that looks like this, and without the credit risk of the bond changing, you could from day to day get different readings just based on movement of the government curve, and it's an interpolated spread based on one data point, this point on the curve. That's it. Whereas the OAS takes advantage of every point on the curve, not even the current curve. It uses the forward curve. The OAS is the better measure of what you get paid to take on credit risk. A G-spread is a very naive credit spread. Do you think getting rid of the first past the post-election system can solve some of the democracy issues you mentioned? It's interesting to think about what the possibility of voting could be. That if you because here we have to say, one person equals one vote. Well, you can always start with that premise and say, does that make sense? Are there some people that just should not get a vote? And we've already agreed that, yeah, there are some people who should not get a vote. If you're less than 18 years old, you should not get a vote. If you're incarcerated, you should not get a vote. So if you're not a citizen but just a resident, you should not get a vote. I don't know if that works in Canada. I think maybe residents get votes. I don't know. But is there some other qualification in which you would get more or fewer votes? Also, by having a ranking system where you simply just rank them might give us a better outcome. I don't know. It's each time we have an election, we always find that there were some issues with the election, or it's not representative because of these reasons. I don't know. I'm not an expert on this one. I wouldn't know how to solve it. My belief is that there are some people in the economy that should have a louder voice than other people. I think that is just an easy statement to make. I think if you have a university degree, you should have 2 votes and not just 1, because you are more informed, or at least the belief is that you've achieved a more enlightened state, that you're going to be less swayed by propaganda and lies. I think if you are a business owner and you employ a certain number of people, you should have a bigger vote, because you know what is good for your company, and what is good for your company is good for your labor force. That would seem to make a lot of sense. I don't know that changing the way we count the vote or count the number of votes is as important as changing the number of votes individuals have. All right. I think doing something like that, I think, would avoid populism, which is where we are now, really, right? And it would force politicians to actually address the issues that matter. I'm not sold on voting my colors, red or blue. I'm sold on, who can do the right thing for the country. That's, if a liberal came along and said, listen, we can't be taxing people 53%, and we can't tax capital the way we're taxing it, we're losing people. And we can't just have these immigration levels without having the housing market for them to live in, because it's just crushing everybody else. And we can't keep running these deficits and building up this debt. We got to start balancing the budget. If a liberal ran on controlled immigration, on lowering tax rates and balancing a budget, I'd vote liberal all day long. Because I think that's the right thing for the country. But I think it's the right thing for the country more so than somebody who's a high school dropout, who's being told that if you vote for a certain candidate, you're going to get stuff. You're just going to get stuff. We're going to tax the rich, we're going to tax capital, and we're going to give it to you. That's good for the individual, but they don't understand enough. I don't think they're enlightened enough to understand that in the long run, that's not good for the country. I think you can fix democracy by getting rid of this one person, one vote system. Nice to think about in terms of, playing around in your head what that means, right? That'll never happen. It'll never happen because it breaks the fundamental principle of a democracy, which is one person, one vote. But I just want you to think about the possibilities. Is it possible that there are some people, by dint of what they own, by what they do, by their background, by their education, that matter more for how the country would, or what the reflection of the country should be? I think there are. I think, one last point on this, I think if you drop out of high school in a developed country like Canada, if you drop out of high school I think two things should happen. You don't get to vote ever, ever, and you sign off on social assistance for the rest of your life, which means you don't get welfare, you don't get health care, you don't get any of that stuff. You get none of the social services, because if you drop out of high school, you're basically unloading yourself onto society by saying there's a high probability you're going to have to carry me all through my life. And I'm going to be bitter at those who have things, so I'm going to vote for higher taxes and job killing things like that, and capital killing things like that, because that's what I want out of it. I think if you drop out of high school, you lose all of that. Now the cost of failure is very high. You want to minimize failure, make the cost high, not lower. Okay, we've gone way too long on that. Very much looking forward to the financial modeling module. If there's someone looking to follow along with the course and apply it to natural resource companies such as FCX, will the approach you take with Costco and cap rate still be broadly applicable? It will, but mining is very particular. In forecasting out mining, revenues are sort of out of their control, because revenues, when we forecast revenues, we have to think about it in terms of price and quantity. And sometimes you have to forecast out what's going to happen with price. We know Costco is raising its membership from 60 to 65, right? Well, the interaction of price and quantity is also very much alive. What will that do to the quantity of memberships? We also know that it's trying to increase its penetration in Gold Star members with executive members, because they pay another fee. They pay twice as much. They pay another 65, but they get 2%. They get a 2% accumulated benefit as they spend money. So we have to think about price, and we got to think about quantity. For a mining company, price is pretty much out of their control. But quantity they have. But usually they have some kind of limitation on quantity, because they have to mill something or they have to leach something. And so they give fairly good forecasts on what their quantity will be, typically over a 5-year period, of in terms of ounces, or in terms of pounds if it's copper, or in terms of tons that they can get. So you can get some good projections on quantity. Price, where are you going to get that? And you have to forecast out for 5 years. So we know what a spot price is today, perhaps, but what about the next 5 years? We can assume hedging, and we can look at the forward curve or the futures curve, and we can say, well, what are the futures prices over these years? And let me just multiply the quantity by the futures price over those next 5 years. Futures price are just a mathematical result of what the spot price is, but if we assume 100% hedging, we can go with that. But if the company has a history of no hedging, there's your problem, the P. That's the big problem, is the P. How are we going to deal with the P? Which is why when we look at commodity prices like copper, and you look at copper miners, if the price of copper is up, the stock price is up. Freeport stock price is up. If the price of copper is down, Freeport price is down, because every penny move on the pound of copper goes right to the bottom line. If the cost is above their production cost, or what are called their cash costs, every penny is off the bottom line or onto the bottom line. And that's why it responds so sensitively to the changing price of the commodity, where something like Costco has a cost in and a cost out, and a maximum markup of 14 to 15%. So when we see inflation doing this kind of stuff, the price of Costco doesn't respond to that price of inflation, because it has a general markup. It's not sensitive to that, and it doesn't change its prices every single day. Whereas the output price of Freeport does change on a daily basis depending on where the spot market is. So with Costco, we do have some power of projecting out price on the memberships. We do have some power in projecting out quantity, because the quantity will be based on how many locations it currently has and how many new locations it's going to add. So we have more power there. So yeah, some of it is transferable in terms of how do you do a depreciation schedule, for example, or how do you account for leases, for example. or dividends or debt. The debt schedule would be pretty much the same thing. I shouldn't say the same, but the same process for doing that. It's just revenues would be different. What are your thoughts on Brookfield? Big asset management company in terms of real estate, in terms of infrastructure, things like that. Renewable subsidiary. I don't know enough about Brookfield to comment on any particular subsidiary. Just starting my due diligence process, Morningstar report, most recent 20F and Brookfield YouTube channel. Lots of things I don't understand, but that's good. Excited for the journey. When you try to understand more on technology of hydro, wind, solar, various pros and cons of each, would you try? Would you then try? Yeah, I would. You're not. I wouldn't try to be an engineering expert on all of them, but understand them as much as you can. Sure. Or you could go on the basis of, listen, I think Brookfield understands the technology here. I don't really need to understand the technology. I just need to understand the application and the size of the application market. So maybe I don't need to understand the technology of hydro. I know there's water and it falls over, and there are turbines and it spins those turbines, and then there are power lines that go to transmission lines that then send that out. Good enough. What's the size of the market? What is the cost per kilowatt hour? Is it a regulated asset they have? I would understand the application for what they have and the size of the market. I don't necessarily need to go into detail about the technology of what they have. I think it's important to understand the tech and its economics in addition to companies' financials. But you have an asset management company. I'm sure that they have experts that have already assessed that, and they own this particular asset. Let's say it's hydroelectric power. They own that particular asset. They've already done the due diligence and the economics on this. The question would then be, what is the cash flow that this is going to generate out into the future, and what is it sensitive to? I think I would understand the application market, not so much the technology. Mid-20s. Concerned about the low growth and productivity in Canada, and the grass in the USA seems to be greener. At least in short term. In the long term, I feel the debt level will catch up and the grass doesn't seem so bright after all. What country do you think would have the greenest grass in the long term? So this is always, the question of where the grass is greener. I would say, if you're looking at Canada and the US, the grass always looks greener on the other side, depending on, where you're standing. It's just the brown spots are in different places. Right? In Canada, you don't have to worry about your healthcare costs. You have a high level of taxation. You have a low level of productivity. But you're not going to be hit by a stray bullet as often as you would in the U.S. In the U.S., you're going to have to pay your healthcare costs, but they have a lower tax system and much higher productivity. But you do have to worry about the stray bullet issue. Right, and if we're looking for capital, this is the home of capital. For now, it's the home of capital, not so much in Canada. If you're looking for opportunity for growth in the economic sphere, the U.S. wins hands down. But keep in mind, your lower taxes are going to be eaten up by your healthcare costs, and the healthcare is not cheap. It's not freaking cheap. You get free healthcare here, but good luck actually getting the free healthcare. And you actually do pay into the healthcare system because you pay higher taxes. So you're actually paying into the healthcare system, and you can get that free healthcare if you can actually get that free healthcare. Lots of Canadians cannot get their free healthcare because they have no access to the healthcare system. They can't get a doctor, and even if they can get a doctor, sometimes it's 2 years to get to a specialist to be able to get to an MRI to find out you got stage 4 cancer, and if we only caught it 2 years ago, right? People with money in Canada go to the US for their health care, but you pay. Lower taxes, but you'll pay for your health care. Higher taxes, but you'll get free health care. Call this the same thing. The productivity and the capital in the US clearly win if you can live with the stray bullet problem. You describe rolling your short ES position out from December to December, which says you net 51 points. I netted 59 when I did it. I did it pre-market. The value of 51 come from valuing the cost to carry. Nope, it just came from ES is, let's say, 5,600. And you're rolling them. ES for December is 56.59. So you buy at 56, you sell at 56.59. Clearly, if you're buying low and selling high, you got to pick up a 59 points on your short position. So if your break even here was 54.50, your new break even now is 55.09, right? You just can add the points right to this. So you get a pickup. And SPX is the spot, and SPX must converge to the futures at expiration. SPX is not going to change that day, and you got to pick up a 59 points. So you basically just narrowed your deficit by 59 points. So if the market goes sideways and your futures are underwater, if you can roll them over the course of, I don't know, 6 months, 9 months, you can work your way to a break even. If the markets aren't on a tear. So I can ignore most of this stuff here. I think you're picking it up here. 56.50 versus 57.11. Let's see. Which I would think. 61. No, 59. I got 59 when I did it, so. I've been interested in financial markets close to a decade. I love the math and always found that accessible, but never made the time to study finance or economics, so I never got the big picture. Then I found your channel and purchased the applied level, and truthfully might change my life. Well, thank you. I don't know if it'll change your life. Just wanted to share that and to say thank you for this wonderful resource. Thanks for the great content. TSLL is a 2x Tesla leveraged ETF. Would you consider buying TSL puts if your conviction on Tesla is so strong? It's 2x leveraged. I imagine that the puts would be twice the premium, right? I don't know that you would get the same. I mean, I'm not going to call them up and look at them, but it seems to me that if you got a 2x leveraged, the 2x leverages have twice the volatility as the 1x, as Tesla would. If it has twice the volatility, it's going into the formula. In Black-Scholes-Merton, your premiums will be twice as much. So the 220 puts on TSLL, I mean, I paid $25. I might have been paying $50 for the same thing because it's 2x, thereby giving me no advantage in the options because the volatility would be double as well. It stands to reason that it would be double, right? If it's 2x leveraged. So I don't know that there'd be an advantage in buying puts on that. But today is Wednesday. Tesla was down on Monday. Tesla was down on Tuesday. Tesla's down another $4.83 a day, down to 204. Can I get a woo up in here? I'm having a good time with those Tesla puts. I might reduce it by 5 puts by the end of the day. Maybe I don't know, maybe 8. Maybe take 10-20% of that trade off. It's been a nice move. I am aware that they do have their October day coming up, but more and more, I think the market is coming to realize that a lot of what is said just isn't going to work out. By the way, Tesla did bring its robot to the robot convention, and while all the other robots were doing really great things, Tesla's robot stood. Oh well, it didn't have his arms up. It stood inside a glass case. Sorry, I don't mean to laugh, but at least it wasn't a person in a robot costume this time. Tesla. Yeah, they so much remind me of RIM now. But where are we here? Yeah, 20, under 205. 3 days in a row it's been straight down, and no bulls have come out to save it. So I may take 10 or 20% of that trade off the table because it happened so fast. When something happens really fast, you can't discount that. Well, maybe I just got lucky on my timing. you know, they are December puts. I might be able to. I don't know. I'll see what happens. I'll see what happens. But so far, it's working out quite well. What about using an EV/EBIT multiple? Demonran has a data set for going back to 99, but it's only annual. Enterprise value multiple by sector. That still shows a multiple of 22 from January. Though, well, so yeah, I guess my thoughts may not change the outcome. That even if you did look at it from an enterprise value, it still might not change much. And it would be consistent with using the operating earnings, because you are using an EBIT multiple. That is before bottom line items. If you're using as reported EPS, the forward multiple is in the high 20s, 25, 26, 27, mid to high 20s. Any video on how to understand share-based compensation, unvested shares, and the impact on stock dilution? Equity share compensation confused me, Renee 10K. You gotta go. Well, you gotta slow down, right? And you just gotta work through it. And what is being granted? Oftentimes, if you look in the changes to shareholder equity, you'll see shares being added because of equity-based compensation, but you'll also see shares being subtracted with a buyback. And the buybacks are usually there such that the net effect would be zero. So it's there to sort of nullify the effect. So Costco tends to do that. They do have a share buyback program, but they have a share incentive program as well. And the two tend to offset each other for the most part, with some slight increase in share count per year. Very small, but there is a slight increase in share count per year. So it's I have no video for that at this point in time. Level 2, the reading on, it used to be a reading just on pensions, a whole reading on that fun topic. But you're seeing fewer and fewer defined benefit plans, so that there's less of a need for that each year that passes. But you're seeing more and more share-based compensation, so that level 2 reading now is got a heavier focus on share-based compensation. So if you are at level 2, that's a good place to start. How do you manage your capital gains throughout the year? Do you try to take losses to lower tax liability, or just tax loss harvest at the end of the year? You know, if it's the end of the year and I'm reassessing my positions and I look at one and I say, you know what, I've been working on this all year. It's got a loss. If I take the loss, what's my tax savings going to be if I take this loss now? And sometimes that tax savings, you look at, you say, well, that would be a gain right away. If I did that, I would gain that much right away. And that gain is equivalent to the stock being at this price instead of this price. So why don't I go ahead and do that? Yeah, sometimes at the end of the year, it makes sense to do that. But not throughout the year. Like in a March, I would never say, oh, okay, I'm going to harvest this now for a tax loss. The only time I take a loss in a March is if I look at it and I say, okay, this is dead. I'm wrong on this one. Let's just stop. Let's just get out. I don't feel like living through another day of this. It's I don't think about it throughout the year. Just as you start getting near the end of the year, some things make sense. Might have missed some of your recent videos. Surprised to hear that you shorted Tesla after a video from over a month ago where you advised do not short the religion. Yeah, it is a religion, or at least it has been a very faithful religion. But I think the religion is dying. You can't not perform miracles for a long period of time and still hope to keep the religion in place. Tesla looked for a while like it had performed a lot of miracles. But I think the miracles it performed was because of a lack of competition. Now they have competition and they don't appear to be capable of competing on that front. And there's more and more questions coming out about its full self-driving, and how come You've got 50 companies around the world with robo-taxis that don't have anywhere near the amount of data Tesla has, but Tesla doesn't have a robo-taxi. And they're going to unveil something that is going to be like the robot, a drawing or a mock-up, and it'll be just around the corner. Just around the corner. And I think that the market has slowly come to recognize that, it's not a religion. It is actually a cult, and the cult is dying. What led you to reconsider? If you watch the news flow, just the success that Waymo is having. Waymo's opening another production facility for its robotaxi. 100,000 rides a week now. GM's Cruise is now going to be on the Uber platform. You've got more autonomous vehicle companies that are actually looking at joining the Uber platform. Uber will be the robotaxi platform, period. Tesla just, the more I reflected on it, the more I thought, this is RIM in 2008. It was a dangerous thing to short because everyone loved it. It could do no wrong. It had the crackberry. Everybody wanted the crackberry. In EV, everybody wanted a Tesla. Not so much anymore. So I don't think that it can compete. And I think it's probably on the same trajectory as BlackBerry is, or BlackBerry was. And I understand the comparison with RIM, especially their failure in the mobile phone business and leadership issues. However, the situation with Tesla seems different. Unlike RIM, Musk is running successful and innovative ventures in parallel, like SpaceX and Neuralink. That's not part of Tesla. When you buy Tesla, you don't get any of that stuff. So what does it matter? What does it matter? Let's say that I have a corner store and I own all of, let's say, all of Apple. I'm the sole owner of Apple and I own a corner store. Would you invest in my corner store just because I own Apple, saying, well, he owns Apple, so the corner store's worth a hell of a lot more? None of that belongs to Tesla. Who cares? SpaceX, Neuralink, they don't belong to Tesla. I see this as a supporting factor for Tesla's overvalued actual pricing. Why? Activities outside Tesla attract mass retail investors who hit the green button during sell-offs when he shows up with verbal interventions. See super optimistic price targets from ARK and Musk as a weaker factor to initiate longer and sharper momentum. Yeah, but ARK, you're choosing the ETF with the title now of being the ETF that has destroyed the single most amount of value in the history of all ETFs. It belongs to ARK. And ARK's forecasts are not serious forecasts. They're not institutional level forecasts. They're retail level forecasts. In other words, their forecast is for a retail market, and they've already figured out that you got to tell the retail market what they want to hear if you want the price to go up. It's not based on any real belief that Tesla's worth that much money. Not in the least. It's based on telling the sheep what they want to hear in hopes that the sheep come along. But the sheep are not. The sheep have not been coming along this week, and it's too long with too many promises that are being under-delivered, with quality issues, with focus issues. The idea of diverting some chips from Tesla to X, of stories of the AI engineers in Tesla being recruited for XAI, raiding his own company, right? With X kind of dying out there in terms of revenue. It looks like Musk will probably have to sell significantly more shares of Tesla or lose X to the creditors. That was just a bad move altogether. I feel okay shorting this one at this point. I could be wrong. The religion could come back. October could come and he could promise really ridiculous stuff and the sheep could believe it and send the stock price to 300. That I'm prepared for something like that to happen, which is why when you're short Tesla, you start thinking about, okay, I'm up a bit. Maybe I should take a little bit off. So yeah, maybe later today with my 40 puts, I might bring them down to 36 or 32. Take, you know, 10 or 20% off. Do you know why passenger airlines have struggled over the past few years? Have anything to do with the price of oil being elevated? With the way they nickel and dime you to death, with the way they lie to you. Air Canada tells me in the app, your first, will tell somebody beside me, you can check a bag for 35, tells me 50. You get to the airport, this is gone, it's now 55. Like, it's the lies. It's just straight lies that they tell you. And the pricing that they charge you, especially if you're a repeat customer, you'll pay more than if you're an initial customer. Your loyalty gets a slap in the face and a gob of spit on your shoes. This is how they treat people. They cut down the amount of flights to pack the airline. They try to, it's surprising to me that they're not making money hand over fist, right? I don't know. I don't know why they've struggled. I'm also taking your word on it that they're struggling. I know Air Canada isn't. I think they lost money last quarter. I don't know. Yeah, it's not my forte. It just seems odd with the way they personalize your pricing and nickel and dime you to death on everything that they're not wildly profitable. Previous market outlook. I asked you if anyone has ever gone back to look at how accurate forward PE estimates on the S&P 500 and I recall correctly, you said it wouldn't matter. A little surprised to hear this. If someone looked back at historical PEs, compared them to what the actual PE turned out to be. But how can you, you mean looking forward versus historical? They would never be. They'd never be the same. They could never be the same. Let's take earnings that are doing this and you're at this point in time. Your forward PE looks this way, your backwards PE looks this way. By the time you get here, are you suggesting that the backwards PE should match this one? Is that sort of how you would judge accuracy? By looking at the trailing historical PE? But that wouldn't account for, cycles. I don't know that the PE, when you think about judging the accuracy of the PE, how would you do that? By what metric would you say that a forward PE was accurate? So if you had a stock that had a forward PE of 30, and let's fast forward 2 years, what metric would you use today to determine whether that was accurate? I'm not sure how we would get that done. Would we look at trailing earnings? Would we look at current forward earnings? Would we look at the stock performance over that period of time? Would you look at the PE versus the growth over that period of time? So I'm really not sure how we would assess the accuracy of that forward PE. You can say, well, did the stock price go up? If the PE was above the market PE, if the forward multiple on the market is 22 and the stock has 30, did it go up faster than the market went up? I think that is about the only real test that you can do. And let's say that it did go up faster than the market. I don't know that you could say the 30 was correct, in as much as you could speak relatively that the 30 was justified, given that the market was at 22. But how do you know the 22 is correct? By what metric would you use? I don't know, because that 22 is context specific. That 22 is got so much in it. It has the competition from other asset classes in there. It has the economic situation in which we all live in. It has a belief about what the future is going to be, an unknowable future, but it has a belief of what the future is going to be. And in the end, it is what it is. You either decide that you're going to buy the market at that price or you're not going to buy the market at that price. So I don't know that it matters in looking at it. It gives you a sense of, okay, I believe the S&P is overvalued at 22, so I'm less likely to be fully invested in this asset class versus other asset classes. It sort of gives me that, but is it right? I have no idea. And So let's think about what the forward PE on the market was 2 years ago. Was it right? I don't know. How would you assess whether it was right or not? I don't know how we would determine whether it was accurate. Wouldn't that hurt the credibility of the forward PE? No, not at all. This whole game is about forecasting the future. If we look at just look at the Fed, for example, and look at what their path of inflation was when inflation was going up. A lot of them had this, and then inflation went up, and then okay, they adjusted and they did this. Inflation went up, and they all did this. Inflation started coming down, and they started doing this. So wrong, 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 probably wrong. They're mostly wrong. If you look at forecasting the future and you take 1,000 people, 1,000 people are mostly wrong. 5% of them might be right or in the neighborhood of right, but probability says that 5% would be in the neighborhood of being right. Does that make them right, or just does that make them statistically in the right place? You're forecasting the future. That's the stock market, and that's been the stock market since been any market since the dawn of time, is forecasting the future, and very few people do it correctly, consistently. Does that change their credibility? We still get up every day and play this game. Doesn't change the credibility of it. We still listen to the Fed's every word. The fact that they've been mostly wrong doesn't change their credibility. So something like a forward PE is just sort of a gauge. Again, it's like being on a scale that's broken. It's not going to tell you what your weight is, but it will tell you over time when you're heavier and lighter. So the forward PE tells us over time when the market is when we're paying more for the market or less for the market. What do you think about companies that provide cooling equipment for data centers like Vertiv? I haven't looked at anything like this at all. Would you consider it a buy? Well, think about the data center. It sits on a piece of land, and you have a center in here, and somebody owns this, and there's a recurring amount of rent that comes on that. Recurring. Beautiful. There's only one piece of land, right? And then let's say that you sell a whole bunch of cooling devices to this. Okay, so there is your source of revenue, but it's going to need energy. Well, that is a recurring source of revenue. So data center REITs, recurring source of revenue. Energy companies, recurring source of revenue. You need copper to get the energy there. You need copper in all of these devices inside here. You need copper in all of these devices. All of these devices require energy as well for cooling. All of running these require energy as well. Where's the money in this? It's in the recurring revenue streams. I sell you an air conditioner. I sell you an air conditioner once. There might be a service contract associated with it, but it really is just an air conditioner at that point in time. So it's, I don't know that I like a model as much, where you have to continually push boxes out the door to generate your recurring revenue, as opposed to build an asset once and then you generate lots of revenue on the same asset again and again and again. So I think with the rise of data centers, if you're looking for plays on the outside, I think the data center REITs and the utility companies in those regions are the big winners. Where are data centers setting up? I think that would be where you would want to look, and you're going to set up as close to the trunk of the internet as you possibly can. Why is money market fund assets included in your market outlook? Well, because it is considered the safest investment that you could put your money in. You can put them right into treasuries, but if you don't have access to buying the securities themselves, or if you don't know how, the easiest way to get that done is through money market funds. So it represents, for me, probably the level of concern that may be out there. If there's low levels of, if there's outflows from money market funds, constant outflows, either money markets aren't paying anything, or there's just a bigger opportunity somewhere. with money flowing into money market funds every week, it seems, given that you have data that suggests that the economy is doing well and that the markets are doing great. Look at the S&P, how much it's up, and you still have money flowing in. Sort of gives you an idea of there seems to be some concern. It's surprising that given that we are entering into a rate cutting cycle, that we're not seeing money leaving money market funds and going into bond funds at this point in time. You're still seeing more money coming into money market funds at both the retail and the institutional level. Don't you find that curious? Right? So it's there just because it's safety. And if everything is so great, what's the record demand for safety all about? When would it be appropriate to start taking position in XLY? That depends on your time frame. If you've got a 6-month time frame, I don't know. If you got a 20-year time frame, any time is appropriate. It's your time frame. Considering the economic data showing the economy is slowing, XLY is forward looking. Way too early to consider a position now. I don't know. And this is the game we play. If you're asking me, I wouldn't be going into discretionary at this point. I'd be looking at banks. I'd be looking at utilities. I think, well, I say don't look at discretionary. I am long GM, but GM is so bloody undervalued. By the way, where is GM today? We are at, still 49.17. If this were valued like any other auto stock, on average, it should be $80. Now, I don't know why it's sitting under 50. But no, I don't know that I'd be going into discretionary at this point. Yeah. But that's me. That's me. If I were 25, I would be saying, you know what, I got 30 years. I'll take it now. I'll just keep adding to it. In IR is a fiscal transfer to the private sector. IR cut reduces the transfer. See the monthly treasury statement. If the private sector doesn't have an appetite for credit, there will be less liquidity. I think at this point the likelihood of expansion of the credit cycle is possible. The level of private debt to GDP is not that high. Typically a rate cut generates a recession, or more slowdown of the credit cycle doesn't compensate for the fiscal transfer reductions due to IR cuts. IR is a fiscal transfer to the private sector. Well, okay, I'm trying to weave your logic together, but I don't know. Maybe it sounded better when you were typing it, but you've missed a few sentences because it seemed obvious to you that I'm not quite putting it together here. Can you explain how TLT works? Like any mutual fund, TLT holds bonds, right? That's all it holds. And those bonds have returns and coupons, and TLT passes that through to you. And since we know what bonds it holds, the price of TLT is a reflection of the total value of all the bonds it holds divided by the number of shares. And there's the value of TLT. Scale of 1 to 10, how reliable do you believe the government data on metrics like unemployment, inflation are? I think they're very reliable. There's a difference between reliable and accurate. The methodology, the statistical methodology, is as reliable as you can get. This is if you had statisticians look at their methodology, I think they'd say, yeah, you're pretty okay, but you're going to suffer from the drawback that all statistics suffer from. Is there's going to be some error in what you're sampling. There's always a sampling error, so you try to minimize the sampling error. And then depending on what the environment is, sometimes the environment may provide a context in which the sample that you're taking may not have numbers that are as accurate as you would like them to be, even though your sampling error mathematically would be low, especially when you have contexts that are out of the range of contexts in which the samples were originally designed for. I wouldn't look for some big conspiracy in government or some big inadequacy like, oh my God, I can't believe they're counting it that way. This is all very, very sophisticated stuff. It's reliable. At times it will have more error than at other times. Tough to understand how weakening U.S. should increase U.S. denominated commodities. Can you explain? Okay, so I'm in Canada. Let's say the price of gold is $300 Canadian, and the price of gold is not going to change much. This would, let's say you discounted it at whatever the exchange rate is, you get to 2,500 USD. And you have and let's say my 3,000 Canadian actually is worth 2,500 US. You have a weakening US dollar, let's say, to keep the same value in gold. You would have to push up the price of gold. The price of gold would have to increase if you're going to keep the 3,000 Canadian value constant. So if we look at the price of gold in all other currencies, because it's priced in the US, the fluctuation in the currency will flow through to the price of gold in every other currency. So what you would get is the combination of gold and the currency. To eliminate the currency effect, the price of the gold would have to go up as the value of the dollar went down so that it stayed constant in the other currencies. That's all. Mentioning the difference in valuing assets between GAAP, IFRS regarding cap rate. If you had to choose between the two as a set of universal reporting standards, which would you choose and why? Probably IFRS. IFRS seems to represent a more true fair value. Well, it attempts to represent a fair value of the company's balance sheet by listing its assets at fair value, at least the investment properties at fair value. Yeah, I think that one. Do you believe U.S. LEI indicators, or do you still find the macro environment weaker? Well, I think the LEI is capturing what it was meant to capture. The question then becomes, is what it is capturing relevant for the economic situation we're in now? And it appears that it was not relevant. Excuse me. Best time of day to sell options. I don't know that there's a best time of day. I try to avoid it, like 5 minutes after the market opens. I try to avoid it there unless you think that there is some volatility spike that you want to take advantage of. I heard you say that sometimes you sell options at the start of the day, then you wait to see what happens until the next move. If I'm going to leg into a strategy, so I may think, well, I want a risk reversal. So and that means buying a call and selling a put. So I may say, well, let me buy the call first. If the stock goes up, I'm already making money. If the stock goes down, it means I can go further down and sell the put. Right? So rather than doing the put and the call at the same time, you buy your initial one. Which to me would be buy the call first, because if the price drops, I get a deeper, I go lower in price to sell the put. If the stock price starts increasing, I'm already making money. So in that case, I cannot lose. Well, at least I'm not losing in that case. Thoughts on U.S. peso or EWW? Judicial reform in Mexico seems to be putting pressure on the peso. I don't know so much if it was judicial reform or Mexico coming out and putting the relations with the embassies on hold because they were critical of Mexico's domestic policy. I played the peso. Excuse me a second here. Let's have a look. 1955. I played the peso yesterday, 1963. I did a scalp long position or a short on the US, 1963 covered at 1945 today. I'll probably do it again. I think it's under pressure right now. Not because of the yen, it seems. More so the weaker US dollar overall. But I'll play the peso again. I don't mind that one. I have a question. Where do you find the implied rates for central bank expectations? In other words, how do you calculate what is priced in based on what rate? Implied rates for the US, you can look at SOFR futures or Fed Fund futures to calculate what the market is pricing. Yep. What about Japan, ECB, or BOE? I don't know what other countries' central bank funds rate would be, but there's always a market reference rate. Always a market reference rate. In the US, it's SOFR. Would it be TIBOR in Japan? Tokyo Interbank Offered Rate, TIBOR. But there's always a market reference rate, and there's always a forward or a futures curve or a futures contract and a futures curve for that rate, because it is a big hedging instrument, a big hedging tool that's used. So it always exists. You just have to figure out what it is. A rental car was a Tesla last week. Not sure what year it was, but sensors sometimes thought people walking next to the car were bears. And at one point, it thought a wall was a bus. I have zero desire to turn decision making for driving to a Tesla when the sensors seem not ready for prime time. Hearing some people on the news mention the options market for predicting the potential move of NVIDIA. I was wondering how you can use the options market to calculate expected moves. Take the price of NVIDIA, whatever the price is, let's say it's 125. Go to the options, look at the 125 call, look at the 125 put, add them together. And that would be, that is an at the market straddle, and that would say at 125, it gives you the implied move either way. Because if you didn't think it would move that much, you would short the straddle. So maybe there's $6 here and $6 here, which is $12. So 12 divided by 125 is roughly about 10% move that the market is pricing in, roughly about a 10% move. Currently building out a system for managing a theta sub portfolio and selecting targets. I've been pursuing either directional thesis or range bound thesis. Good. Wondering what other these could also fit. I think if you have a directional thesis or a range bound, I think you're good on, well, I mean, those are the two things you would need. One of the two. What other? Do you typically stay away from index ETFs because of their low IV? Not really. No, it depends, but not really. I don't know that you want to concentrate your whole portfolio in high IV stocks. You know, you want a few that are under 20, some between 20 and 30, maybe a couple that are over 30, but if you're going to be over 40, maybe only one or two. You certainly don't want to focus on just maximizing the premium as a percentage of the stock price. You don't want to do that, because when the market does turn, those things will hurt badly. You want some low IV ones. For the new position vids on your site, will you respond to questions left there? I have been answering the questions left in the comment section, but yes, I will respond to questions there. I'm aware you're standing towards so-called wealth tax on high net worth individuals. Well, when you say standing towards, I don't believe in a wealth tax. I just see one coming. The matter is a significant portion of them are not taking realized capital gains in their portfolio, instead only borrowing against it for expenditures and writing off the payment and interest expense. Same thing that you can do, okay? You don't have to be wealthy to do that. You can do that as well. It's the same thing that you can do. Anybody who takes a home line of equity to repair their home is doing the same thing. Why not take the capital gain out of your house? Why not sell your house and just build a new one? right? It's the same thing you could. Why not sell some stocks in your portfolio and fix your house? Why are you getting a home line of equity? Same thing that you can do. So before we go any further, okay, criticizing wealthy people for doing it, you can do it too. Anybody can do it. That's what makes it democratic. It's not as if it's a policy that only wealthy people can use. Anybody can use it. Now, your argument might be, but some people don't have wealth. Listen, you need a medical degree to operate on someone. Okay? To say that, well, I can't operate on someone, it's because you don't have a medical degree. To say that, well, I can't take advantage of this because I don't have wealth, well, you didn't put in the work to get it. Much like you didn't put in the work to get a medical degree. Anybody can do it. That some people don't do it is either lack of knowledge, they have the ability to do it, but they just lack knowledge, or they have bad advisors, or the bank is certainly not going to tell them that they can do that, or they haven't put in the work to get the wealth. But if they had the wealth, they could do it. They can do it. This is one of the features of modern economy which really widens the wealth gap, and there doesn't seem to be any end to it. Have any thoughts? Too bad. If we believe in democracy, one vote for one person, we believe in equality. There should be equality under the law. That means equality under the tax law, not equity. Right? If you think one person, one vote, we must also think one tax law applies to everyone. You cannot suddenly have tax laws that only apply to people who are wealthy, who say, well, I can do this, but you can't because I have wealth. But if you had wealth, you could do it yourself. That is not a changing tax law. That is one tax law for everyone, except that you can't take advantage of it because you don't have wealth. There is a write-off for having children. I have no children. I don't get that write-off. Is that a fair tax? All of a sudden I should say, well, that's not a fair tax. It should change. No, if you had a kid, the tax law, you could take advantage of that tax law. That you don't have kids, you can't suddenly call it unfair. Oh, people with families are paying lower taxes than me because they have kids. Unfair. People who are wealthy can borrow against their unrealized capital gains. Unfair. No, if I had a kid, I get a kid write-off. If you had wealth, you could do the same thing. It's one tax law for everyone. So no, I don't think that going after, I mean, if we're going to do that, if we're going to say, aha, they're taking advantage of something that somebody can't, not because the tax law is different, but because the person's situation is different, I say we go after families with lots of kids, and we put a kid tax on them, saying you can't take all these deductions for all these kids. You can't take all these deductions. Other people don't have kids like you have kids. So you're abusing the system. It's the same thing. If you think about it now, it's the same thing. You have a lot of wealth. This person doesn't have a lot of wealth. You're abusing the system because you're taking advantage of something that somebody with no wealth can't, even though they could if they had the wealth. Let's say the same thing to people with a lot of kids. You're abusing the system. You can't take this many deductions, right? What about an employer who has a whole bunch of employees and is writing off the expense of the employees, and their net income is lower and they're paying lower tax? Oh, you're abusing the system. You can't take all these write-offs. This business over here doesn't have as many employees as you have. You have more employees. You're abusing the system. See where it can go? It can go in a lot of places, right? You have one law that everyone can take advantage of. Because your situation is such that you can't take advantage of it doesn't negate the value of the tax law. I have no kids. That does not negate the value of a write-off for children. All right. Any benefit of reading the minutes of the FOMC? I think there is. It's just oftentimes when you read it, what you're going to get out of it is, okay, we already sort of thought that this was what was going on. What is interesting is to see what they pay attention to, because the minutes will say, well, we looked at this and we looked at that and we looked at this and this is what was going on here. And it's like, oh, okay, you guys are looking at the same things I'm looking at. Opinion on Berkshire. They crossed $1 trillion today in value. Given its cash holdings and stock portfolio, how would one value the business to determine a fair value? Well, it is a holding company, so it should be worth the net asset value of the companies that it holds. The stock portfolio should probably have a holding company discount. I don't know that it's a holding company in the sense of what a holding company, a publicly traded holding company, would be today, where you have a sort of a centralized management system. Each business is a separate business. I don't know. I don't know that I would say that. It has benefited from T-bill interest income and increased insurance premiums the last couple of years. These benefits may soon disappear. Warren mentioned during the recent meeting he doesn't expect utilities and BNSF to perform well due to regulatory headwinds and labor issues. I don't know. I've never owned Berkshire. I don't know that I really care to. I don't know that I have an opinion either way on that one. Recently signed up for the applied level, haven't had a chance to start the modules. I saw someone mention in the comments they've been having a lot of success with the 10-20 delta theta strategy. You discuss the strategy and the models. It's in applied options. Yes, I do. In income strategies, go to applied options and income strategies. Excuse me. Has anyone downloaded the CFA videos from Mark Meldrum app? You mean into the app? If so, does it disappear after a specific amount of time, or does it stay down in the download section? I don't know how that works now. It stays in the download section till the exam, or till after the exam, and then they do disappear. How do you value oil stocks? Like, if the price of oil goes up, is it beneficial for the oil company? Absolutely. What is the factor that drive oil stocks? Oil prices. Oil prices, you got it. Not a finance guy. Learning through applied series. Appreciate your advice on the situation. Sold at the money puts expiring in January 25 on a stock. Recently rallied, followed strong earnings report. Now has a delta of 12. Very bullish on the stock in the long run, but I anticipate a pullback in the short term after the rally. Could you please outline the scenarios for maximizing profits, rolling the position for a higher delta? Well, if you expect a pullback, I wouldn't roll it to a higher delta just yet. Closing the position, booking the profit, and waiting for the stock price to drop before initiating a new at the money position. That seems like better than one. Selling and out of the money call. No. Just because you expect a pullback doesn't mean you're going to get one. If you're long-term bullish, I would not sell a call unless you own the underlying shares. If you own the underlying shares, then you have a covered call. Okay, then you're fine. But no. Get rid of 3 if it's just options. Are you willing to have the stock put to you? If you are, then do number 1. If you're not, then do number 2. Live Q&A, you said max position typically 2%. Yep. However, you usually only have around 8 individual names. Right now, yes. Do you increase this 2% limit in a more favorable economic environment? I do. Oh no, I don't increase the 2% limit. I increase the number of names I have. I've added, let me have a look here. 1, 2, 3, 4. I've added 4 names that are medium conviction, that are probably on their way to high conviction at this point in time. So I am increasing the number of stocks that I'm going to be carrying, and I'm moving into these 4 positions over time, because I think I can set up an allocation factory on them and an income factory at the same time. So these are nice dividend payers in Canada. What do you make of Goldman's call that OPEC will potentially increase output in order to strategically discipline shale producers? They've done it before. They did do that before. They aren't showing as much production restraint. Does this change your Oxy put target price? No, because if it's put to me, I don't mind holding it. I really don't. Also, happy birthday for Saturday. Hope it's a good one. Yes, it is this Saturday, August 31st. I'll be 8 years old. How do you know that? How do you know Saturday was my birthday? What do you know about me? Came across a great article that talked about Tesla's bogus inventory calculation methods. Wondering if you come across this before. No. Inventory calculation. I keep reading about all these Teslas piling up in parking lots and fields. And then when they report their quarterlies, when they report how much inventory they have, it's like, well, that doesn't make sense. If these stories, maybe they're just stories then, because, but maybe there is something there. I don't know. They base on automotive news methodology using an arbitrary 75 days. Wondering if you come across this before. No, I haven't. I have not. Question about the Fed's balance sheet, currency in circulation, 2.3 trillion liability, offsetting asset account for this. I don't know that I would say it's a single offsetting account. Offsetting account for that. Probably it would be the securities position. Without me thinking through it deeply, would be the securities position. The currency in circulation is a liability on the Fed's balance sheet. So from the Treasury, you'd have to have securities. Comes to DRIP, reinvestment for dividend paying stocks. Are there situations where you reinvest and others where you take the cash payout? I used to do DRIPs a lot because it was just easy to think about. I don't do them anymore. The price that you get is the average price of the stock for the 5 days before the dividend was paid. So it's more of a moving average that you're getting. I don't bother with that anymore because I usually stick with dividend paying stock. Stick with dividend paying stocks that have options, so I can manufacture another dividend on top of the dividend that I get. And then if I want to buy more, because I'm perfectly fine when I sell a put, having them being put to me, that I don't need the DRIP to accumulate shares, because I have other strategies to do that with. LEI's weakness was led by non-financial components and the yield spread. Well, the yield spread is inverted, so whenever it's inverted, it's a signal of a recession. Excuse me. As far as the non-financial components, I haven't really looked to see which components were affecting it, but being that it has not really worked this cycle as a signal, it has less viability. So I don't know that doing a dive on it matters. The market doesn't seem to think it matters. Thoughts on Canadian utility companies? Interesting company called Capital Power. I don't know anything about Capital Power. Enbridge, yes. Capital Power, no. What's your forecast on Oxy, given Buffett hasn't bought any in a while? Crown Rock is looking to offload 29, but well, it's going to be under pressure because of that. They have to swallow the whole thing now. I don't know that I have price targets. I even in things that I'm in now, I don't have a target as much as a directional bias, or an anti-bias, or an anti-directional bias. Let's say Oxy, I think, is fairly well supported at the $55 level. Where can it go? I don't know. But that's not what I'm playing. I'm not really playing an upside direction on it as much as I don't think it's got a lot of downside to it, and I don't mind owning it. What could some catalysts that could Oxy drop below 55? Economic recession, oil prices dropping below $70 a barrel, below 60. You get WTI going down to about 50. You can get Oxy trading below 55. Yeah, quite easily. What's your opinion on international exposure for diversification? Well, you're taking on currency risk, and probably different tax regimes when it comes to withholding. So this idea of most investors have a home country bias. There's usually a good reason why it's a home country bias, is because there's less risk associated with the currency and there's a more favorable tax treatment if the income is derived from your domestic market. We got much more to go. We do, eh? Okay. Opinion on how much more there is for gold. I have no idea how much more there is for gold. Whenever it comes to the future, my answer is always going to be the same. I don't know. Beats me. Nobody knows. That's not me taking the cop out and saying, "Oh, the guy doesn't know." Nobody knows what's in the future. I think it's a waste of time trying to predict a price of something, as much as you should be looking at, well, what is the direction of something? What would support gold prices going higher? Well, a weaker US dollar. Do you think you're going to get more of that? Lower yields per ore being mined. The lack of a new big gold field being found. Well, all of those things are in place. Increasing demand from central banks due to more concern about the U.S. as a reserve currency, more concern about the volatility of currencies. All those things are in place. So they're supportive of higher prices. What's the price target? I haven't got a clue. Nobody knows. I mean, pick a number out of thin air. $3,000. How does that sound? But nobody knows. I don't know that it's worth saying here's a price target as much as it is saying what are the things that are supportive of gold prices. Are those things in place, and are those trends expected to continue? And if the answer is yes, then the bias is to the upside. How is the forward price of a stock calculated? Take the stock price, S naught, E to the R minus Q, T in years. R is the continuously compounded risk-free rate, because we're using risk-neutral probabilities here. Q is the continuously compounded dividend rate. Stock with no dividend, it's simply S naught E to the RT. So if it's 6 months, T is 0.5. If R is 5.5%, that's 0.55. So E to the power of 0.055 times 0.5 multiplied by the stock price, and you will get your forward price. Okay, what do you think about Hindenburg research? I don't know if I have any thoughts on that one. I haven't really spent any time reviewing their style or how they do things. Their latest call seems to have something to it. Could you please explain again how to interpret the movements of up and down on the RRP, TGA, and reserve numbers? I don't know that you would interpret the moves as much as be aware of, from week to week what's going on. I don't know that there's a lot of information in the TGA. The reverse repo will eventually find its way to zero. The reverse repo, when the money market funds have way too much money and there aren't enough securities to put them in, or enough demand for repos in the market in general, the Fed doesn't want money market funds pushing down yields, so it opens up the reverse repo. Is it possible to share other 10Ks which were used for the previous videos of the sector studies? Yeah, I still have them. Yeah, I'll figure something out. Long January. Oh, is this the same one we saw earlier? 110 synthetic with $10 credit in my account. Margin requirements $34.30. Received 1,000 commission. So actually, money tied with the contract is $24.30. Isn't it a sure profit provided the duration of TLT and rate cutting environment? No. What if TLT drops to $90? You have a synthetic. You can create a synthetic at any price. You should basically have the share price. So as the share price moves, your gain or loss will move. Nothing is a sure profit. T-bills are a sure profit. Also long XLU 76 synthetic January 25. Do you see any upside on XLU in the next 4 months? The environment is supportive of upside for XLU with rate cuts coming and utility demand increasing. All that could change at 4 o'clock when Nvidia reports earnings. If they miss and they say, you know, data center demand looks like it's falling away, well then so will utility need for data centers, you know, be downgraded. Break down bonds the way you do equities, the same format as the sector studies. How would I do that? Bonds are mathematically priced, really. I don't know that there's a reason to do it for bonds. When I do a sector study for a company, if the company has bonds, you can make the decision about the bonds as much as you make the decision about the equity. If you're bullish on the equity, you got to be bullish on the bonds. Because equities have a residual claim. If you're bullish on or bearish on the equity, then you might be concerned about the bonds. But I don't know that it would be any different for the bonds. Probably not. Level 1, February, preparing for it now. Is it advisable to get the applied level now, or shall I wait next iterations? Iteration? I don't do iterations on the applied level, just additions. If one takes the applied level, will the previous ones be available too? What are the previous ones? Yeah, maybe you're thinking about this, that every year it's different. No, the content stays the same. If there's a sector study or an option strategy, that doesn't change from year to year. There'll just be more of them. So you can add it at any time. What module will showcase new positions each week? Portfolio construction. Level 3 candidate recently read Options Volatility and Price by Sheldon Natenberg. Good. Any recommendations on what books I should start next? Well, how many books do you want to read? At some point, stop reading and start doing. I would say, like, you know, you can't keep preparing for the fight your whole life. At some point, you got to get in the fight. Get into the fight. That's how you learn at this point in time. I don't know that reading another book is going to help. No, I wouldn't recommend reading more. I'd just say, just start doing it now. Why don't you open your own hedge fund? I don't want to. GM shareholders might be affected by fraud. Levinsky and Curry. This is one of those ambulance chasing firms that every time a stock price drops for whatever reason, shareholders who might have lost money, please contact us. Let's see if we can get a class action going. And you'll call them and you'll say, if you only give us $300 or $400, and everyone gives us $300 or $400, it'll cover the legal costs. These are ambulance chasers. If you look at almost any company that had a stock price drop, you'll see this law firm's name along with a whole bunch of these ambulance chaser law firms that do the rounds, and that's all they do. They have no other skill set than to chase. Their ambulances are, the stock price dropped $3 out of nowhere. Maybe, let's see if we can get people who lost money who are angry enough to give us money so that we can get legal fees here. These are look at ABR. How many different law firms are after it? Look at Lamb Weston, same thing. Fraud. Ambulance chasers. Ignore that. Nobody pays attention to those headlines. Nobody pays attention to them. Good problem to have. But when do you decide you should close a profitable synthetic? I don't know that I said that I was closing XLU as much as taking some off the table, right? Just paring down the position a little bit. That's all. So when I put the position on, it was a synthetic at 70, 50 of them, which comes to 350K. Well, once you get up to $75 times the 50, you're at 300 and was that 375K. So you have a bit of a gain in there. Well, take some of the gain off, bring it back down to 350. It's okay to take money off the table, right? Why do you just use naked puts for income as opposed to bull puts? But why sell the other one? I mean, why pay for the other one? I don't want to pay for the other one. Cap risk. I don't see it as cap risk. I want to own the underlying anyways. I have no problem owning the underlying. No problem with it at all. So that's why I wouldn't use a spread. How important is location in equity research? Yeah, no, I don't think it's important. Living in the prairies, I have an interest in equity research as a career goal. A few years down the line. Informational edge available here in areas such as oil, gas, mining, agriculture that wouldn't be present in large centers. Yeah, maybe. Or are the networks in big cities so big that I would be left behind? I don't know the answer to that one really. It's like saying, well, if I'm going to be a mining analyst, shouldn't I be up in, a city like Timmins? Well, there's no equity analyst firms in Timmins, and just because you're in the same city as a mining company doesn't mean you have access to better information if they don't talk to you. It's not as if information is spilling over in the streets. However, what you do have is a lot of people who work for the mines who have stories to tell, who can say, oh, we're busy as hell, or we're not busy, or there are layoffs coming. You're closer to the people who might be talking about it. I don't know where you are in Saskatchewan if you're in an area where people are always talking about the industry. You might have some input or some information that's not captured somewhere else. I don't know about that. I'm not in any major financial center, and I do okay because the information is easy to get. I do have issues every now and then. I will say that it would be nice to be able to walk down the hall and grab an accountant and say, can you show me the transactions that created this so that I'm trying to figure out how I model this going forward or how I think about this account. But I'm not an accountant, so sometimes I don't understand the accounting standard or the policy or the transaction or the journal entries that created the account. That would be helpful to have that. I imagine working on a floor with a whole bunch of other people would save me a lot of time from figuring it out myself when I could just walk over to another desk and say, hey, you're an expert in this. Can you just explain this to me? Because once I hear it, well, then I know it. But if I got to go searching for it, right, it could be hours of my time. How the multiple on S&P 500 would be 17x instead of 21x using your fair value estimate and cash holdings. Well, let's say that you're looking at a business that earns, let's say, $5 a share and is selling for 20 times earnings. It's selling for $100. And you want to buy this business, and on its balance sheet it has $50 of cash. Well, when you buy the business, you buy all the assets and liabilities. So if it has $50 of cash, you're really paying $50 for the business, because if you paid $100, you can pay yourself back $50 right away. So this is really selling at 10 times earnings, right? I'm going to have to end soon because my voice is just not coming along for the ride here. Love to hear your thoughts on government price gouging. Government price gouging? Do you mean taxes? That's a clever way to say high taxes, government price gouging. I think that's what you mean. I'm not really sure. Or do you perhaps mean government's accusations of companies engaging in price gouging? Well, if we're talking about the accusations, there's always something there. I think there's some part of that that's true, and then there's some part of it I think they don't understand. But there's some part of it that's probably true. The way capitalism is today, and from what I've seen from some companies that sell almost absolute garbage and charge a fee for, wouldn't you call that price gouging? Um, Personalized pricing, wouldn't you call that price gouging? When I get a higher price only because the company's figured out I have more money, wouldn't you call that price gouging? So I think there's some truth to the price gouging. That to say that companies are not price gouging, I think would be naive. To say that all they're doing is price gouging, I think is just as naive. There's some element of it. I think there's some element of it there. Possible to include an analysis of the current business cycle in the US. I keep getting asked about this business cycle thing, and my answer is always the same. Why would it matter to you at this point in time? How would it change anything that you're doing, knowing that we're in one phase or another phase? Like, I'm not sure that it really matters for what you would do. I spend no time, zero time thinking about what phase of the business cycle we're in. I don't care. It simply just doesn't matter. I've had this question so many times over the last 6-7 months, and I keep coming up with a blank as to why would it matter what phase we're in. um, I guess I'm sort of just lost as to why so many people think it's so important to know what phase we're in at this point in time. What would it change what you would do? I don't know that it would change much relative to the euro area. I know nothing about the euro area. I've said this many times. I know nothing about other markets. The US market, yes. I grew up in Canada my whole life. I barely know much about the Canadian market. I know nothing about other markets at all. Several conflicting indicators like GDP growth in Q2 alongside a contracting ISM PMI that make it challenging. It has been that way for 2 years. Macro has been brutally difficult. Brutally difficult. It's challenging most of the time. But in the last couple of years, it's been almost impossible because you have a story on both sides of the economic data, but in the end, you got to make a bet. In the end, you gotta take a position. You got to take a direction. And at this point in time, I don't think it really matters to try to figure out exactly where we are in the business cycle, because it's not going to change the fact that you have conflicting data. So let's say I say we're in the slowdown. You would think, well, the contraction is next. Doesn't have to be. It could be an expansion from the slowdown. It could be growth from a slowdown, right? So what would it matter where we are? I think, trying to figure out where we're going matters more. And if you can't figure out where the economy is going, you try to figure out where some things are going. You work with what do I know for sure? I know central banks are cutting rates. Bank of Canada has cut rates, signaling that there's more to come. Jerome Powell has come out and said now is the time to cut rates. Well, I know we're cutting rates. Is the economy going into a recession? Haven't got a clue. No idea. But I know rates are being cut. So what does that mean for me? Utilities. Great, because utilities will be priced out as bonds. Well, what if we are going into the recession? Utilities outperform in recessions. What if we're not? Utilities outperform when rates are being cut. See, I win either way. So I look for things. Well, what do I really know for sure? And then you can sort of eliminate having to forecast other things by taking them out of the picture. What about banks? Banks do very well when rates are being cut. What if we're going to a recession? Well, then they don't do so well, but they got high dividend yields and they have options. So there's a trading strategy for me. I can have a nice allocation factory and an income factory with banks, regardless of the outcome that I get. I think that is more useful than saying we're in a slowdown. try to, not get too mired down in what is going on today. Try to say, well, what do I know for sure? Make a list of the things you know for sure, and then the things that you simply cannot predict, like what's going to happen tomorrow. No idea what's going to happen tomorrow. I have no idea. 25,000 shares of cap rate under 2% of portfolio. Correct. It would be nice if you spoke some more about how to size options positions. I've already done that many times. You size it based on a theta. So you take the market value of your portfolio or whatever cash value you have, multiply by 0.001, and that should be the maximum theta that you have. And then you could start selling calls and selling puts until you hit your theta, and there's the size of your position. When I was selling GM puts, I did it on a cash secured basis. If the puts were assigned, I would have 5% position. Kind of feel I should have done more, and then risk manager, the price fell even more. Yeah, this is, you do it this way. When you get very good at 0.001, move it to 2. When you get very good at 2, move it to 3. And of course, you may get to the ultimate, which is 0.01, which is it's a lot of management to do, but it's lucrative if you can get it to 0.01. But start with 1/10 of that, 0.001, and then slowly move up. Do you know if the format of the exam is going to change? Is the AM still SR heavy, PM still? Oh, this changed years ago, or 2 years ago. So the AM is SR followed by multiple choice, followed by SR, followed by multiple choice, and the PM is the same thing as well. They're interleaved now. Applied series available on an app, not yet. What do you think of closed-end funds in private equity or venture capital? I don't have any thought on them as a group, other than, okay, it gives you access to private equity or venture capital where you otherwise wouldn't have access to it. Is this a viable option to add diversification? Yeah, I can imagine. I can imagine so. Yeah, but unless you have a more specific question, like what do you think of them? I've thought nothing of them. But if you have, like, if something more, that's a big question. Like me saying, well, what do you think of daylight? I think it's a good thing. Like, what do you mean? What do I think of it? Like, what are you getting at? Closed-end funds, there's only one thing I would say about closed-end funds in general, not about them being private equity or venture capital. But a closed-end fund can sell above or below its net asset value. There is nothing in place that would bring it back to its net asset value because it's closed end. So it trades in the market, so it can trade on sentiment and trade above its net asset value or below. You kind of want to avoid buying closed-end funds above their net asset value because the net asset value is an attractor point. So if you are looking at them, make sure you have some assessment of their net asset value. Now, it's going to be probably level 3 inputs to assess net asset value because these are illiquid holdings. So it'll be some kind of estimate as to what the fund thinks the net asset value is. But whatever the closed-end fund is, see if you can, focus more on those that are selling at a discount to net asset value. And that's it.